The Genius Act recently passed by the United States is all set to change our lives. Until now, only governments issued currencies. Now the Genius Act allows non-government entities like banks and even non-banks like an Amazon to issue currencies called payment stable coins. Now, what are payment stable coins? They are midway between currencies like dollar and cryptocurrencies like Bitcoin. Stable coins are defined by the Genius Act as any digital token that is recorded on a cryptographically secured distributed ledger. The Genius Act establishes a regulatory framework for payment stable coins. Who can issue payment stable coins? All banks and insured depository institutions like credit unions in the US can issue payment coins. Now, just for an explanation, an insured depository institution is one that takes deposits from savers and gets insurance protection from the FDIC. Non-bank entities can also seek a license to issue payment stable coins. All companies that want a stable coin issuing license have to go to one of the following three regulators. One, large banks regulated by the Federal Reserve have to go to the Fed for such a license. Smaller banks or credit unions that want to issue less than $10 billion of stable coins may seek a license from the state banking regulators. Non-banks like, say, a Walmart or Amazon or even Tether and Circle have to go to the OCC or the Office of the Controller of Currency for a license to issue payment stable coins. Now, payment stable coins aren't going to come very soon, okay? The Federal Reserve, the FDIC, the Treasury Secretary, and each state payment stablecoin regulator will have to issue implementing regulations after seeking comments from the public. The Act says that these rules have to be made within 1 year of the enactment of the Genius Act. The regulators have to make rules regarding capital requirements, liquidity standards, reserve asset diversification standards, interest rate risk management standards, and standards related to operational, compliance, information technology risk management, etc. The Genius Act takes effect 18 months after the enactment of the law or 120 days after the primary federal stablecoin regulators have issued their final implementation regulations. Since the Genius Act was signed into law by President Trump on July 18th, 2025, one may expect these stablecoins to become effective payment instruments by around January 2027. Though it is not common for regulators to take longer to frame the rules. For instance, the Dodd-Frank Act was passed in July 2010, but regulators made rules only by 2013. Some part of that act were implemented only by 2015. So it may well take more than 2 years for payments through stablecoins to take effect. There is an additional hurdle. For companies like Walmart or Tether, the rule is no non-bank can issue payment stablecoins unless it obtains a unanimous vote from the Stablecoin Certification Review Committee. This committee is made up of the Treasury Secretary, the Chairman of the Federal Reserve, and the Chairman of the FDIC. And it is possible that these eminent regulators won't give licenses very easily unless they are convinced of the robustness of the companies that are applying for such licenses. While the detailed rules are still to be made, the Genius Act sets out some basic rules. Issuers have to back every coin that they issue with equivalent cash or US Treasuries. Also, issuers have to comply with anti-money laundering laws and they have to report suspicious activity. They have also to report every month the composition of their reserve portfolio on their website, which means make it public. These monthly reports must be examined by a registered public accounting firm, an auditor. And the CEO and the CFO of the payment stablecoin issuer must certify the accuracy of these reports to the regulators. The primary use of these payment stable coins could be for retailers. Retailers like Amazon.com or Walmart, who have announced their intent to issue stable coins. They expect to save millions in terms of fees, merchant discount charges to banks and card companies. It also ensures instantaneous payments like India's own UPI across suppliers and buyers. Another ready use case for stable coins is international transfers. Today, sending a $100 remittance from the US can cost like 6% in terms of fees, and it can take days to clear. Compliant stable coins can cut that cost to just pennies and the time taken to just seconds. The US government might be another beneficiary of the Genius Act. Some estimates say that mandatory treasury bill backing means stable coin companies could become top buyers of US treasuries. Who are the losers? Visa and MasterCard shares have been slipping amid fears that, on-chain dollars could steal settlement volumes from these card companies. Banks may also lose some income from retailers. Also, they may lose the idle float if companies start paying, say, part of their salaries via stable coins. But despite a long history of auditing and regulation, banks have failed. So, stablecoin issuers have a far more light touch regulation. If these companies cheat on the rules, if they issue more coins than they keep reserves in the form of dollars, they can collapse. Remember, the Silicon Valley Bank failed because the value of the underlying treasuries fell. This can happen yet again, and it can set off a chain reaction of defaults. Experts doubt if regulators can keep track of so many more uninsured issuers of currency like tech firms and crypto startups. So those are the fears generated by the Genius Act. Well, that's the preface. I now have with me two economists, Professor Barry Eichengreen and Professor Eswar Prasad, who are experts in the field of both money and currencies and have worked on cryptocurrencies. First, let me invite Professor Barry Eichengreen, who recently published a very critical piece in the New York Times saying that the Genius Act will bring economic chaos. So, with that, let me welcome you, Professor Eichengreen. Thank you very much for your time. First up, the detailed rules as to who will issue the stable coins, what will be the capital and reserve requirements, are yet to be written by the Fed and the FDIC. Now, if these organizations make the rules very strict, can that chaos be avoided? You don't think that's possible?
I do not. So we have to see what the regulations will look like. So the Genius Act permits the FDIC and the Fed and the other regulators to promulgate rules for stablecoin issuers, but it'll be 18 months until we see the rules. And there is plenty of historical evidence suggesting that issuers can get around rules. They can bend them, and I worry about their ability to stay one step ahead of the regulators.
Okay. You say 18 months. Who all have to write rules? Is it the FIDC? Which are the regulators?
It is the comptroller of the currency and the U.S. Treasury. I think that will be in the lead in writing these regulations, and the Genius Act gives them a window of time.
Okay. Is there any advantage at all that you see in stable coins that is not being, achieved by the sovereign US dollar?
Well, it depends who you are. If you're a resident of India, you already have UPI. Yes. So you can make instant payments at low cost between bank accounts, and having a new set of payment rails doesn't do much for you domestically. Dollar stablecoins may be an advantage in doing cross-border payments, however. So that's the one place where people in India may feel a difference, although UPI is being linked with the comparable system in Singapore and elsewhere. So there are other ways besides stablecoins of doing the same thing.
Okay. Well, I will come to the cross-border transactions in just a minute. Why are you fearing that there can be chaos because of the issue of these private coins?
Well, there will be many different private coins and no guarantee that they will trade one-to-one for one another or that they will be interoperable. So there will be Amazon coin and Walmart coin. Can you use Amazon coin at Walmart or Walmart coin at Amazon? Will there be an exchange where you can trade one for the other? We don't know. So there could be many different tokens trading at many different prices, putting at risk what economists refer to as the singleness of money, where every dollar is worth a dollar and can be used everywhere, or every rupee is worth a rupee and can be used everywhere.
Well, the rules appear to suggest that for every dollar issued, there should be US Treasuries backing, and that there will also be capital prescribed for the issuers themselves, so that if there is a hit, it is the shareholders' capital that is first taking the hit. You don't think these are safeguards enough?
No, I don't, because I think we've seen plenty of counterexamples where existing stablecoins have been backed not only by treasury bills, but by bank deposits at places like Silicon Valley Bank, where they turned out not to be so safe after all. And the stablecoin in question went to a discount. We've seen money market mutual funds in the United States that broke the buck where a dollar share fell below a dollar because supposedly safe bonds turned out not to be safe. I think we need to worry about that more generally in the Genius Act context.
Okay. Okay. Yes, there is a possibility that, the face value of the bonds fall because of a rise in interest rates and the company is incurring losses and there is a panic withdrawal. But in the case of, let me try my best to see if there is any advantage at all. Do you think that the stable coin will, help the issuer earn money, make a profit because they are backed by treasuries? And on the other hand, will it make it very easy for the United States to fund its debt, to finance its debt?
If stablecoin circulation grows the way people like Treasury Secretary Scott Bessent anticipate, so there might be $2 trillion worth of stablecoins outstanding, backed by $2 trillion of treasury bonds and bills by 2028 or so. That would create additional demand for US treasuries and therefore strengthen the dollar. But it's also a volatile form of demand where there could be run-on stablecoins that backing would have to be liquidated all at once, and that could crash the treasury market. So I would say in this context, be careful what you hope for.
Okay. Well, and from the issuer's point of view, the only profit they make is the yield on the treasuries. That's the only way they have to fund the whole thing?
That's basically how they fund the thing, exactly. They take my dollars and your rupee, and they issue you a token. They invest them in treasuries, and they earn some interest on that. They give us, you and me, payment services. The idea being that payments will be faster and cheaper than they will be using credit cards, bank accounts, or UPI, to which I would ask how much cheaper and faster.
Okay. Well, let me look at it from an India point of view. Would a country like India or Indonesia or Philippines, any other sovereign country, be afraid of stable coins? I mean, why would an Indian government want to lose control over the rupee or even the amount of rupees that are transacted into dollars? They may want to retain that sovereignty. Do you think that sovereignty will be challenged, their ability to make monetary policy?
I do think it will be. 99.5% of stablecoin circulation at the moment is in US dollars. So if they begin to circulate in India, that is the equivalent of dollarization, where people are shifting out of rupee into dollars for their payments and transactions. And that leaves the Reserve Bank of India with less leverage over the economy. It's called currency substitution, and it is a problem for central banks.
But can't governments, other governments, legislate it out, render it illegal to do domestic transactions in dollars?
They can try. That's what domestic financial regulation is for, but a lot of questionable things go on in the crypto sphere. Every time governments try to outlaw crypto transactions, crypto users tend to find a way around those restrictions. So it will be a race, if you will, between the greyhounds, the investors, and the bloodhounds, the regulators.
Oh, that sounds scary, Professor. But thanks for alerting us about the red flags. And thank you for spending time with us today. We have to take a break on that note. Thereafter, a chat with Professor Eswar Prasad from Cornell University. Welcome back to our Genius Act and Stablecoins special. Earlier this week, I spoke with Professor Eswar Prasad. He's Professor of Economics at Cornell University and author of a book on cryptocurrencies called The Future of Digital Money. I began by asking him, how will the world of currencies and payments look, say, in a couple of years? Will people in the US stop using Visa and MasterCards and only use stablecoins for payment? Here is a slice of the chat I had with him.
We're certainly entering a wild and interesting world of private payment mechanisms circulating in tandem with the traditional payment mechanisms like fiat currencies issued by central banks and also commercial bank deposits, which have been a very important payment mechanism. Now, it's worth thinking about why stable coins are getting so much traction. And I think this is where stable coins have really proved useful in terms of showing us how much more efficient payments can be, both domestically, within the world of decentralized finance, and especially in terms of cross-border payments, where there are enormous inefficiencies, very high costs, very slow processing speeds. So in my mind, the real legacy of stable coins, whatever happens to stable coins themselves, is showing us how much more efficient payments can be. Now, given that we have the legitimization of stable coins, certainly there are going to be incentives for private companies like Amazon, Walmart, perhaps even social media companies like Meta, which once upon a time did have a stable coin project that was killed by the US government, to go back to starting to issue their own stable coins. And there is logic to this because at one level, you want to think about private firms that have very large balance sheets, that are very large networks, adding on a payment mechanism on top of their existing networks. The difficulty, of course, is that we're going to have multiple payment mechanisms, and it's not entirely clear if all of these are going to be equally reliable. So it's a good thing from the point of view of consumers and businesses that the cost of payments, the frictions in payments, both domestic and international, are going to decline. But we could be in a period of some volatility when we have multiple payment mechanisms and some of them turn out to be less than ideal. And as you pointed out in the introduction, some of them could end up being ones that facilitate illicit activities, money laundering activities, and so on. So the big question is whether we are moving to a more stable regime or one that is in some ways efficient, but could also create a lot of instability.
What's your sense about cross-border, sir? I mean, I'm trying to look at the impact on India first, or countries like India. If we don't recognize stable coins, if we, stay quiet about it, mum about it, then obviously I cannot pay for an Amazon product with stable coins. In that case, do you think countries like us will be impacted in any way?
It is a potentially worrying time for central banks around the world. Even the European Central Bank has come out with a statement that it is worried that it could lose monetary policy autonomy if stable coins become much more prevalent, especially because it looks like the stable coins that the world desires are really dollar-backed stable coins. And given that a dollar-backed stable coin, whether issued by a company like Tether or a big company that has a global footprint like Amazon and so on, that could have much more trust from consumers and businesses around the world than local currencies. I don't think in India we face as much of a problem, but certainly there are concerns that these stable coins issued by US issuers in particular could start becoming very widely used around the world. Now, certainly regulations in a country like India can, to some extent, forestall this from happening. But the reality is that it's going to be very difficult to manage the use of stable coins by private parties, especially because the US financial system remains dominant, and for people to shift onto that financial system is going to become a lot easier thanks to the prevalence of stable coins. But I think the fundamental issue is whether this is going to catalyze every country to start innovating in terms of payments. India, in my view, is already very far ahead of most other countries, both advanced and emerging market countries, in terms of the efficiency of its payment systems, thanks to the UPI. So I think India has somewhat less to fear in terms of domestic payments being disrupted, but certainly cross-border payments are going to be disrupted.
Yes, it is. Cross-border is very expensive. I mean, I think if I have to remit $100, we spend almost 5% in terms of cost of, paying the banks on this side and that side. So clearly cross-border is very, very inefficient and very profitable for the banking system. But if the Indian government, or any, for that matter, say Indonesian or Philippine, any of the Asian governments advise or direct their citizens not to pay in stable coins, then do you think the system will be thwarted or impacted in any way? Do you expect them to come up with such rules?
I expect that many national governments and central banks will do their best to try to limit the proliferation of stablecoin usage within their own economies, even if it is largely for cross-border payments. But the unfortunate reality that many of these governments are going to face is that if there is such a wide gap in terms of the processing cost, the processing speed, the ability to track transactions and so on, and especially as stablecoins become more legitimized in Western financial systems, especially the US financial system, it's going to become much more difficult to control. My view has been that when you think about cryptocurrencies, especially stablecoins, they're going to substantially reduce the efficiency of capital controls, the ability of national governments or central banks to limit the usage of foreign currencies by their own citizens, and the ability to control both capital outflows and inflows. So I think a far better response by national governments is going to be to beef up their own domestic payment systems and to have their financial institutions start adopting some of these new technologies in order to make cross-border payments quicker, cheaper, much easier to track. That, I think, is the only realistic response that countries have, in addition to improving their own monetary and other policies so that their currencies don't get crowded out by these easily available private currencies from advanced economies.
Okay. Thank you very much, Professor Prasad, for joining me with your analysis of stablecoins and tariffs. We have to wrap up this edition of Indianomics on that note. More news and updates await you after the break.